itemizing at 20.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're having a great time.
We are.
Talking taxes, how to minimize taxes. That's the best part.
Yeah.
All right, but first, for the first 10 callers to my office, 615-376-5325. Tess is standing by to get your information. Again, 615-376-5325. There it is for you. First 10 callers, if you would like a free retirement income analysis, and by that I also mean a comprehensive financial plan. This includes, we get into all kinds of things, including, of course, tax strategies and tax planning, which is all about minimizing taxes as much as we can this year, but also looking forward to how we can minimize taxes in the future. Imagine again what I was saying about if we can reduce your taxes down to 12%, all right, as opposed to 22%. That's an 80% savings, huge, all right, for the future. And this is one thing. I pay 12% now, so I don't have to pay 22% later, right? This is that pay me now, pay me later. Well, pay me less now, or pay me more later. We want to pay the less now, right? All right, 615-376-5325. We get into other things. We do an investment analysis for you. Let's take a look at your current investments, how you're structured. I can show you what your financial future looks like based on the things you're doing today, and then share strategies with you to show you how to improve it. So if you're one of the first 10 callers to my office, 615-376-5325. Tess is standing by to get your information. She'll send you out a little packet, a checklist of things to bring to your appointment with me. And in addition, when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And then we cover one of the chapters there, IRA Mastery, deals a lot with some of the things we're going to talk about today with regard to tax savings and Roth conversions in particular. This is one of those areas that, you know, it's just underutilized. The Roth is probably one of the best things that ever came out of Congress in terms of a way to save your money and grow it tax-free. I mean, tax-deferred is great, as with 401ks and IRAs. Tax-free, exactly, even better, right? So if you want to see, you know, this is one of the things I'm going to, in fact, we were talking about tax tips here. Friday we were talking at the break a little bit about required minimum distributions, and this is one of those areas. Understanding again, couple age 65 or older, you've got a standard deduction of $26,500.
Right.
For them.
Under the 2018 tax law, correct. That's the new ones, no personal exemption available. So being able to do what you might have been able to do in the past, and we've had a couple different formats that we've always used in the last 20 years, but basically being able to itemize is going to be really, really hard to hit that 26, because I always think that a lot of my clients are extremely good givers, but 10% is what they usually give. So if you make $100,000, maybe about $10,000. Your property taxes, you know, we have sales tax in Tennessee, and many people at that age might not have mortgage interest, may or may not. But you know, but with the property tax, the sales tax, and they're charitable, they were still meeting that 15,000, was it 400, 500, whatever it was in the past, and they were still itemizing. About 15, 15.3, I think. And so then you turn around and you've got the new 2018. They're still doing the same giving, and so there's only 2 games you can actually play now, as far as I'm concerned. One is the RMD, required minimum distribution. So if you have a required minimum distribution and you have a charity that you always give to, a church or something, you might find that you could give directly through your required minimum distribution through the fiduciary side. They would send it directly to the church or wherever you're giving it, as long as it's a qualified charity, and you won't pay any tax. You're going to get your 1099-R. It's going to show box 1 how much you took. It's going to show how much went to the charity. You don't itemize, which means we don't have to meet that $26,000. And so you'll get instant gratification. The other would be the game that we often play with people that are not meeting the they're not old enough, you're not taking RMDs yet, would be to split the year. So every other year you would give to your charity. Every other year you give to your, you would pay your property taxes. In Tennessee, we get our bill in November, but they're not due till February, I believe. So you could pay your bill in December and January, or January and December, excuse me, in one year, and then the next year not pay it, and so on. As long as it doesn't exceed $10,000, you would be able to take that off under your SALT or under that portion of the itemizing. And then charity, the same thing. Instead of 10,000, you would have 20,000 or as close to 20. Now, between those two, you would still be itemizing, even meeting that $26,000. So it's, you know, and that's for people normally under the age of 70 and a half, I would do.
So think of that. So there you go. I mean, you're going to be talking $10,000 that you can give to charity. You're going to, let's say you give every year. It's $10,000, whatever the dollar amount is for you, and you're paying, and it's taxable income if it's coming out of an IRA.
Right.
So you take that money out of an IRA, you pay the tax on it, and you give to the charity. Wouldn't it be nice if you took the money out, or rather than take the money out, just have the money go direct? And this is the key. It's got to go direct from the custodian, the IRA custodian, to the charity. But you do that now, not taxable income anymore. It just went to the charity, 100% write-off. You don't have to pay tax on it in advance of your gift. Great way, again, to minimize taxes and still accomplish all your charitable giving goals. In fact, it's a great way to take advantage of that.
Yeah. It has to be your required minimum distribution portion, though, not if you're taking money from an IRA at that age just for living.
Yeah.
That is not the whole amount, just whatever your required minimum distribution is.
So that means you have to be 70 and a half, right? To have those required, or older, to have those required minimum distributions. And this is one of the things. It's kind of like the IRS is now contributing to your church or something.
I know,
isn't it?
That's cool?
Kind of neat.
I like that.
I like that. Better use of the money that way than most of the ways they use the money.
Well, because a lot of the phone calls I've been getting lately is a lot of people are emailing. They're saying, well, you're telling me we can't write off our charitable contributions anymore.
Right.
And that's not really the new tax law. You can still write it off. You just have to be giving more, or they're going to give you free money in exchange. So the fact is, if you never itemized, if you were taking the standard deduction and you're a family of two, a husband and wife, whatever, and you took the personal exemption, you're getting almost $1,300 more in the current tax law, the 2018, than you were getting before. They're giving you more of a tax-free. So the concern of giving to charity or not, itemizing or not, really doesn't come into play.
Yeah, and this is one of the areas when it comes to understanding how the tax code works. So again, couple age 65 or old, and by the way, to put this, if you're, the reason I keep saying 65 or older, because we're talking retirement, and that's what
that's the usual retirement
time. Now, if you're under 65, the standard deduction for a married couple is $24,000.
Right. For
a single person, $12,000. When you hit age 65, then $1,250 for each of you, so $2,500 more. $26,500 is a standard deduction. Then the next $19,050 is taxed at 10%.
Right.
So think about it. First $26,500, zero tax. Next $19,000, 10% tax. Then you got approximately $57,000, give or take, that's taxed at 12%. When you total it all up, about $104,000 for a couple age 65 or older, which then still stays in that 12% bracket, and your total effective tax rate. So that means that once you get over, $26,500 plus $19,000, so we're at about $45,550. Once you cross that, you're paying 12% tax on everything above that. All right, up into, again, the 104 total, at which point it would cross over and you'd start paying 22% tax on the money that went above that, and of course the brackets go up from there. Right. So one of the things to understand with this is how can you use that, again, to your advantage in knowing how this tax code works. So if you've got 104, you're in a 12% bracket, effective tax rate, as we said, about 8.56. In other words, the average rate you're paying over all the dollars. You're paying about $8,900 in taxes on $104,000 in income.
Because it is a progressive tax code. Even though we keep going 10, 12, 22, it works its way up. So we start with almost zero and work our way, well, we do start with zero, and you work your way up to those percentages. So it's not straight out the first dollar you make is 10%. So that's why we say effective versus marginal. Yeah.
I'm going to share some stats with you here.
Oh no, here he goes. He loves these.
Right? That's right. Do you realize that by 2030, every single baby boomer will be over the age of 65? Where will the money go to provide benefits for the retirees, right? Did you know there are around 74 million baby boomers? That's a lot of people, isn't it? A lot of people. When you look at our population, I think that puts it somewhere around 25% of the population, give or take. Now, here's another piece about this. 90% of Americans who don't have any money, and 10% that do. And let's see if I can find the stat again about the people paying in. There it is. 80% of Americans pay more in payroll taxes. 8 out of 10 people pay more in payroll taxes than they do in income taxes. Right. All right? 46% of Americans, almost half of Americans, pay no federal income tax at all. Right. The top 10% of taxpayers pay more federal income tax than the bottom 90% of all taxpayers. Right. Think about that. The top 10 are paying more in taxes than the other 90% combined. American taxpayers will pay more federal income tax. Yep. American will need the 10%ers money to take care of the 90% of Americans who really don't have any money. So this is one of the things to consider. Where do you fall? Are you in the 10% or the 90%? And by that I mean, do you have money or do you not have money? Okay, because this is one of those areas that you're, you know, when it comes to planning for your retirement, right? It's part of it being a good saver. You've saved money up. You've, you know, prepared for retirement. You've got money set aside so that when you reach those retirement years, you're going to be able to take money out of your savings to be able to supplement your income, because we know Social Security is kind of hard to live on that alone, isn't it? So, and if you don't have a pension, and most people don't, I think it's something like only about less than 20% now of Americans have pensions that they'll have when they retire. So if you're only going to have Social Security or some small pension even, and now how do you make up the difference? Well, those 401ks, those IRAs, those monies you've been saving all this time, it's going to be using that now. That's going to be the key, right? So it's not just this lump sum of money. Oh, yay, I got all this money. No, it's how am I going to get, how much income can I get from that money? And of course, minimizing taxes means more you get to keep as far as that income, and that's a big part of this as well.
And I think
we're going to take a break. I'm sorry. We're going to come right back to it. So right down that.
That's right.
We're going to take a break. When we come back, we're going to jump right back in and show you some ways that you can, you know, again, reduce taxes, and understanding that those stats that I was just giving you, what that means with regard to a couple of things, right? If you've got money, that means, do you think the government maybe knows that a little bit? And when it comes to taxes, how they're going to do the tax code is going to be about how to get some of those dollars back from you. And are there some strategies that we can maybe get ahead of that? Wouldn't that be a nice thing to do, so that you help minimize taxes for yourself, keep more of your money? It's not just what you make, it's what you keep. We want you to keep more in your pocket. All right, we're going to take a break. Join us here. We'll be right back on the Retirement Report.